Welcome back to the Daily Nugget, Daily Property Insights. One topic, 20 minutes or less, 7 days a week. Myself, Lawrence Lotze, and today joined by Matt Harris, a property tax specialist and fellow property investor. And Matt, the question to you today, which should be, it's all over the news at the moment recently, is inflation. Obviously, it's not going the right way, or it's not going the way most of us expected in the New Zealand market at the moment. And what does that mean as a fellow property investor and the impact to our lives?
I love this topic. I've been talking about inflation actually for about 3 or 4 months now, and you and I actually had quite a good webinar on inflation. And I think it's something that is a integral part of our economic system, and generally just kind of simmers in the background. So the government's mandate is to keep it under 2% annually, and most people don't notice it. But if you've been a property investor or even a property developer in the last 12 months, you would have started noticing inflation quite a while ago, because the cost of building materials has been inflating rapidly, 18 to 25% a month on some materials. And if you've got a trade account like I do, and you get the emails, every month there's a list of items where the price has gone up. So inflation is something that obviously is a big deal. And what happened for the first sort of the last 12 months is that inflation was pretty much confined to the property market. House prices were inflating, property materials were inflating, but we didn't see it spilling out into day-to-day life so much. And what's happened is that it's kind of caught up in New Zealand. A number of tax changes and other things have gone on in the property market, and suddenly it's poured out into the real world. So everyone would have seen in the news this week that inflation has gone ballistic, as some people have termed in the media, and it's at 4.9% for the quarter to September. So huge inflation. And if you put petrol in your car lately, you would have definitely noticed it. Or if you bought tomatoes, I don't spend a lot of time at the supermarket, but obviously with lockdown, I've spent more time than I would, and I've really noticed some things like tomatoes and things like that are really expensive. So inflation is one of those things that it both helps and hinders you as an asset owner, so a property investor, and obviously this is a property focused show. Inflation does help you to some extent, and what we're seeing in the property market is that house prices are inflating quite rapidly, and if you're developing properties, the price of materials inflating isn't necessarily an issue as long as you're completing your developments quickly, because the price of your end price of your developments are also going up. But in real terms, inflation erodes the value of your dollar. So what we will expect to see over the next sort of 6 to 12 months is that your earnings power, or the buying power of your earnings, is reducing significantly by the amount of inflation. And then in some things a lot more. So housing obviously is running a lot more than 4.5%. And I think that if you try to buy a spa or a jet ski or a luxury vehicle in the last 6 months, you would have noticed there's a lot more. So what happens when we have really high inflation? Well, that puts pressure on businesses. Businesses have to pay their staff more, than they have to pass those costs on to the consumer, and you get a big cycle. And the other thing that happens, and all property investors will also be aware, is that the government or the Reserve Bank has a mandate to control inflation, and one of the main levers they pull to do that is the official cash rate. So we had a rise recently, 0.5. What will happen is that probably we can expect at least one more, and I'm not an economist. There's a huge amount of arguments either way here. I personally believe that they're not going to have to pull the lever as hard, because the amount of debt that New Zealand has, or household debt, is a lot higher than it's ever been. So that means that less OCR rises will have the same effect as the last time they had to do it. But what will happen is that they will pull that lever, interest rates will increase, and the theory behind that is that household spending decreases because you have to pay more for your mortgages. Businesses have to pay more for capital. So I think it's when I look at that and OCRs, there's a lot of sort of noise out in the media, and a lot of my clients ring me. I think it's a natural part of an economic cycle. I think that the media is responsible for a lot of sensationalism around it. Having said that, it does need to be taken seriously, and people with larger portfolios or with tighter incomes will need to start looking at things like their interest rates, and if they are concerned, they might need to lock those and have a bit of a gamble.
Yeah, it is an interesting one, right? Fundamentally, it's the inflation just highlights things getting expensive or things getting cheaper. Things never get cheaper, really. And when you get into a point when the inflation is a lot higher than expected, you're going to see some drastic changes if that people aren't prepared for it. That the harshness is that people get further away. So when inflation's at 5%, and then you get hyperinflation in other countries, as you sit every single day, you are actually so much further away into over the last 12 months than you thought. And then they're trying to chase people, trying to get into the property market, people trying to invest, and so forth. It just means it's almost impossible after a certain period of times, and that's where countries are going to hyperinflation. People that own properties are laughing because their stuff just increases 10%, 20% year on year and year, and the person in the back of the line that's not in it is just another 20% behind, another 20% behind. And fundamentally, our income doesn't fluctuate with inflation. The minimum wage doesn't fluctuate. I mean, they take it into consideration, but it doesn't fluctuate with inflation directly. So it does make those challenges, and it's something we've got to pay attention to, depending if you want to get into the game, get into it as quick as possible, or if you're already in the game, it's a bonus for you.
It is, and I like that you've mentioned hyperinflation, because that is the textbook outcome of quantitative easing. So pretty much economic theory says if you print a lot of money, you should get hyperinflation. What we know from the last 50 or so years of quantitative easing is that hyperinflation generally only occurs in the property market and the stock market, so assets. It also actually occurs in luxury goods, vehicles, and the spa bath that you can't order at the moment. But it is an outcome, and the obvious outcome, which you've nailed completely, is inequality. The gap between those that have assets and those that do not grows wider and wider.
Yep. So I totally agree with that, Matt. But we'll leave that there today for the daily nugget. Just had little thoughts and thoughts for people out there. And as always, if you've got some questions for myself or Matt, details will be in the descriptions, depending on what platform you're listening on to. And thanks again for coming over to the Daily Nugget, Daily Property Insights, one topic, 20 minutes or less, 7 days a week. And as always,